And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes, brought to you by ABSA CIB, proud sponsor of the Bonds, Loans and ESG Africa 2025 conference from the 25th to the 26th of March at the Cape Town International Convention Centre. Good evening, I'm Stephen Grootes. Welcome to the programme tonight. We'll talk about steel policy and trade policy in just a moment. And I've always made this point that trying to work out international trade policy is a bit like quantum physics. If you do one thing, something somewhere else changes. And that's the problem that I think we're going to have in this. I mean, some of it, looking at some of the early initial reporting of it, may sort of almost be doomed to disaster. Some of it may work. But overriding all of it is just the sheer complexity. And this is going to be, I think, the big problem. Donald Mackay will explain it further and with a lot more expertise in just a moment. I don't know if you've been following all of the stories from the beginning of the year from different publications, many of them online publications, around what's going to happen to electricity prices, and particularly for people who have solar panels in their homes. And at the start of the year, there were a few, they seem to me almost to be slightly scarce stories. And I don't say anything against the publications that published them. They clearly had some kind of inkling of what was coming. And then it seems over the weekend, perhaps late on Thursday rather, over the long weekend, some inkling, and Carel Payton had an important story in News 24 about this yesterday. It does seem that Eskom wants to charge a home that has a solar installation 30,000 Rand to register that. They say it seems the cost is because there can be leakage from the installation to the main grid. My understanding is that that in fact is not the case. My concern is that if you say to someone who has already invested money in a solar installation, probably through your bond, I think that's how people who do have solar installations have generally done it. If you say to them, give me 30,000 Rand or I'll disconnect you from the grid, they're going to say, I give you 30,000 Rand and I get nothing in return, or I spend the 30,000 Rand on myself. I spend it on more battery storage, or I spend it on a backup generator for rainy days or something, and I'm going to go off the grid, which for you would be the more rational choice. Not everyone would be able to do that. My concern is that Eskom is just going to cut its face to, it's going to just basically mess this up. And that what you're going to see is that people who are currently paying for some of their electricity will cut themselves off from the grid. Eskom helpfully says it'll cut you off if you don't pay. And so that'll save you that little operation. And all that means is they won't be getting any money at all from those customers. We'll find out a bit more about it in about an hour from now. But that's my concern. And let me just be clear. One of the key things South Africa needs to do in this transition, this electricity transition, is to make sure the rich and the poor are in the same network, because otherwise you lose the ability to subsidize the poor. And if we don't do that, we are going to be in serious trouble. And I fear that this is going to become hopelessly politicized, and that's where it'll end up. And then confirmation today, Action SA say they're not going to back a budget that has a VAT increase. Now, this means that the ANC now surely is beginning to run out of options. The DA won't do it, MK won't do it, the EFF won't do it. When they all agree, I think that must say something. But it does also tell you the problems that the ANC is now going to have. And I do wonder if, in the end, the Finance Minister, Enoch Godongwana, as difficult as it will be for him and for the ANC and for the National Treasury, is going to have to swallow this in some way. And there might be further implications of that, but a very difficult situation. We'll speak to Dr. Ralph Matega during the program on that. Your views, please. Would you pay 30,000 Rand as a registration fee? Receive nothing in return? 011-883-0702, 021-446-0567, and of course voice notes this evening on 072-702-1702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, several reports today that the Minister in the Department of Trade, Industry and Competition, Park Stow, now believing to be optimistic that there will be some way to save the Longs steel production facility run by ArcelorMittal, in a move that could actually see government paying the salaries of workers at least for a period. But there will also now be a wholesale review of all the tariffs that relate to steel. The idea is to protect our steel production or our steel industry. And this could include a system of import permits. In other words, presumably, some imports of steel would be banned, or some products would not be allowed to be into the country. Donald Mackay is director at XA International Trade Advisors. Donald, good evening. I really do appreciate the time. From what I can see, this proposal would mean that you would actually have to request permission to import certain products. And I presume there would have to be some sort of surveillance system. would a system like this even work?
Well, that does appear to be what they're proposing. For every restriction that you put in like this, you would need somebody on the other side to actually shuffle the paper around. And the body who would have to do that is the International Trade Administration Commission, which is already under a tremendous amount of pressure with their workload. They are shorthanded. So I'm not optimistic that they would be able to cope with the volume, but that appears to be what is being proposed. And presumably, some people could be declined in that process.
I mean, it would be quite a strange situation. I can imagine someone making a human rights case, even to the Constitutional Court. I want to import this product. I have a right to. Why are you stopping me? I mean, I realize trade law might well prevent that. But I mean, it is quite a strange thing to do, to just say you cannot bring in this product, full stop, finish and klar.
Yeah, so I don't know that actually happens at the end of this. I mean, it's a possibility, and it seems to be what is being proposed. But it would also fall foul of the World Trade Organization rules, especially if you take such an incredibly blanket view across the whole of the sector. I mean, what South Africa is proposing to do is something very similar to what President Trump is doing in the US with these blanket tariffs, or just kind of hitting the whole sector with a very wide range of tariffs and other protectionist measures, all in one shot, without any kind of analysis of what the specific situation is for the particular part of the steel value chain you find yourself in.
There's a large number of codes that currently relate to steel products, as I understand it. There's quite a lot of complexity to this. And I would imagine that none of this can really be done very quickly, or it could be done quickly. The risk is that it wouldn't be properly thought through.
Well, so this is, certainly I've been doing this for a little bit now, and this is the most complex investigation we've ever seen. So there are an incredibly large number of moving parts. It covers over 600 tariff codes, about 67 billion rands worth of imports a year. It goes everywhere from primary steel products like just hot-rolled coil all the way through to padlocks. It covers stainless steel. It covers garden tools and cutlery, steel pipes, etc. So the scope of it is absolutely enormous. And the minister has said he'd like to have initial feedback by July. So how that happens is truly beyond me, without either a corner being cut or the minister getting a very short note in July.
What we're trying to do is protect the steel industry, and a steel industry in a very difficult situation. I mean, the long steel business in Newcastle seems to have lost what were its major advantages, which were cheap coal and its proximity to sort of other mining. I realize this will sound pretty heartless to the people who lose their jobs, but to keep this going would require a long-running subsidy. It would require quite extreme interventions in trade policy. I mean, we have to ask the question, is it worth it?
So I certainly don't know offhand if it is worth it, but we need to perhaps think that, firstly, the steel industry is not one company. The steel industry is quite a long value chain, and they're currently looking at protecting that whole value chain in kind of one sweep. So what will happen with that is you will put up the price of the hot-rolled coil, for example, which would make the pipe manufacturer a little less competitive. And then people would import the pipe. So they say, well, we'll also put up the tariff on the pipe. And at some point, what happens is you get to the end of the value chain and everything's very expensive and we consume less of it. Or we say, well, I wouldn't have used a plastic pipe or a concrete pipe, but in this case, maybe I will because it's more cost effective. So I'm not a fan of working in this way because I think you're going to create more problems than you will solve. But nevertheless, this is the path that they have chosen.
So, I mean, there have been all sorts of issues around trade policy with regard to steel over the years. What would a rational trade policy look like right now? I mean, the demand for steel on global markets is low. That makes it very difficult and almost a very difficult time at which to create this kind of policy.
Yeah, so the whole world is struggling at the moment with depressed demand, particularly since China's construction sector fell over. So there's too much steel chasing far too few projects, and so the price of steel globally has collapsed. And that obviously does need some kind of attention. But the problem in South Africa is that, let's assume all of that was working fine. You would still have the problem that Newcastle can't get their iron ore to them cost effectively because Transnet's not working properly. You still have the problem of Newcastle competing with the mini mills who are subsidized. And so there's about 8.5 billion a year going into the mini mills who produce steel out of scrap metal. That problem still remains. And maybe the decision of government is, well, we want both of them. But then what's going to happen is you're going to have to bake in a permanent subsidy to offset the effect. That doesn't seem like a great idea either. So, I think the situation we're dealing with is a decade worth of people not wanting to actually count the trade-offs and just looking at the upside of protecting or subsidizing a sector with the assumption that there's no cost involved to doing that. And I think what we're confronting now is the reality of that cost. In an artificial market, government has to keep sustaining that market because nobody's addressing the basics like the example I'd given of rail.
Donald, thank you very much indeed. Donald Mackay is Director at XA International Trade Advisors.
702. Stephen is on X.
At Stephen Grootes.
Well, yesterday on The Money Show, you heard the CEO of CSM Consulting Services. He explained to you how, because even though his firm had done work for government departments, the fact government departments had not paid the company, not paid his company, means he now has to retrench people. And in fact, Jonathan Oppenheimer, who was on the program last night, felt moved to comment on the same issue. It's an indication, I think, of how important this is. We did today speak to the Department of Public Works and Infrastructure. We spoke to them this afternoon to see if they would give us a response. We were told that only the minister is the person who can speak about this. He is unfortunately unavailable this evening. We will keep trying, and we'll hopefully get him on the program tomorrow or later in the week. Tebogo Kaas is the Global Chief Entrepreneur for the Institute of Chartered Entrepreneurs. Tebogo, good evening. Good to talk to you again. I mean, this clearly does happen quite often, right? Where governments ask a company, they sign a contract, they say to a company, do this work, and we will pay you this amount of money, and the company has to wait ages for the money.
It certainly does, Stephen. It's a recurring problem that seems to not being resolved at all. In fact, it's getting worse by every year. If you look at the National Treasury's report last year of on non-compliance with payment of enterprise or suppliers within 30 days, you will see that in amounts ranging over 10 billion rand still remain outstanding for more than 30 days. And with that, you must understand that it means that somebody has to bear the cost of the interest penalties incurred by the businesses. And it is often small businesses also at the brunt of all this.
It's not the officials' money that they're not paying, right? I can understand if it's my money, why I wouldn't want to pay you, Tebogo. But it's government's money. It's actually it's people's money. It's society's money. Why are people so scared of paying out the money? Is there a problem in government with making a decision?
You know, it's a bit complicated, and for no reason it is complicated. I'll say that because in most instances you find that the department itself, let's say Department of Public Works and Infrastructure, engages the service of an implementing agent. It could be the DBSA or any other entity to actually ensure that there's fulfillment of the contract. That on its own creates another layer of added bureaucracy, which makes decision-making difficult and also payment lags. And with that, you must also, include the fact that there's also corruption in the system, whereupon if you don't grease certain hands, sometimes your payment gets delayed in terms of it being paid on time. But be that as it may, we've got lots of projects, some of them going back more than 10 years. I mean, you just have to look at the Department of Defense, the military hospitals, where you've got contracts that have been running for more than 10 years, and some of whom actually had to change suppliers, contractors, for various reasons, and mostly related to non-performance on the part of government, but also corruption being at the forefront of that. And where there's disputes, obviously it protects the whole delivery, and payment also gets to be bogged down in all that until the matters are resolved.
Tebogo, I remember years ago as a political reporter being told this would be sorted out, minister after minister, we'll fix this. Nothing has changed in all of that time. Maybe it's the system, maybe it's the people making the decisions. That's what seems strange to me. It does seem that there's no real interest in sorting it out. I think even President Ramaphosa has promised to sort it out.
Well, everybody has promised to sort it out. In fact, everybody rushes to the nearest mic to actually tell the public that problems of non-payment of government suppliers are a thing of the past, when in fact that is not the case. We have seen this problem growing, actually. I remember in 2005 when the provincial government struggled to pay SMEs, and we end up with SMEs having to fold at the rate of more than 50% of those who are doing business with the provincial government. That has actually not changed, especially after COVID, where most SMEs or small business are trying to pull themselves up, even large businesses, and government becomes affected in them being viable, and some of them are threatened cash flow-wise, to an extent where they might actually have to lay off workers. And that is something that is not acceptable in this economic climate.
Tebogo Khas, thanks very much indeed. Really appreciate the time. Global Chief Entrepreneur at the Institute of Chartered Entrepreneurs. As I say, we had hoped to speak to the Minister tonight about this. The Minister of Public Works and Infrastructure does seem to fall under him, Dean McPherson from the DA. We will continue to try and engage with that department again tomorrow to see if we are able to get a response to this. But as you heard Tebogo say, this issue has a very long history.
The Money Show.
The Markets.
Marco Eustafio is from Equity Sales at Absa CIB. Marco, good evening. Welcome to the Money Show studio. Big day for Anglo-American. They're very involved in this project in Finland, the Sakati project, and an important update for them from the EU.
Yes, absolutely, Stephen. So it's been classified as a strategic project by the European Commission. And what this means is they're very likely to get efficient processing of permits applications and more predictable development timelines. So well cheered in the market today with the stock up 3.4%, nicely outperforming the rest of the top 40.
And obviously to get mining permission in the EU never been the easiest thing. This is one of the reasons why this is so important.
Absolutely. This is looking to produce about 100,000 tons of copper equivalent metal by the 2030s. Most of that will be used in the EU for very strategic decarbonization of their transport system mainly.
The timing is fascinating because there was a time when the EU would have just relied on global supply chains. Now, of course, you don't really want to do that. After the pandemic, there was the process of nearshoring. You want to be able to get stuff in case there's a problem. Now, of course, with Trump at the Trump administration in the White House, you actually want to make sure you produce some of the stuff as close to home as you can.
I think that's absolutely right, Stephen, and you'll probably see far more of these strategic projects coming out of the European Commission.
Closer to home, Pepkor finally, this deal's been going on for 2 years, isn't it? They finally got legit Boardmans and Swagger style.
Yeah, that's right. It was a very interesting transaction for me. As you say, on the go for 2 years. They didn't get the core brands around Edgar's, and I think the market's sort of scratching their heads around why that was the case. I guess given it's an unlisted company, much more difficult to determine whether that's a positive or a negative thing. I think worth noting, less than 2% of Pepkor's market cap being spent on this deal. They are adding 462 stores. That's about 7% increase in number of stores. So looks like a fairly good deal on the face of it for Pepkor.
It's interesting to see how it'll play out. And then so much has been going on with platinum group metals lately. My go up, my head goes up and down, and my pendulum swings from left to right. But Impala at one point, their share price was down quite significantly. Seemed to recover towards the end.
Absolutely, Stephen. It has been exceptionally volatile through the PGM stocks over the last few days. Really looks like rhodium coming off the year-to-date highs affecting all of those, but having a little bit of a relief rally today. As you say, Impala was the underperformer, bouncing into the end of the day. So interesting moves overall there. I think we will continue to see lots of volatility in that space as sort of supply and demand dynamics peter out through early April.
I mean, a lot of it's related to the transition to the kind of new cars we're going to drive are going to be quite different and how people perceive that process. At the same time, we've got gold still over $3,000 and kind of hasn't really strayed below that since it passed that market. I mean, commodities at the moment is a fascinating place to be.
Absolutely right. I think you continue to see gold price in those risk factors that we're seeing in the world, where PGMs, sort of look at the outlook and worry probably 5 or 10 years out that electric vehicles could very well replace them completely.
Thanks very much indeed for coming in. Marco Eustachio is from Absa CIB. He is in equity sales there. Plenty to come on the Money Show in just a moment. We'll speak to the Chief Financial Officer at Remgro about their performances and how that's been going. And then Dr. Ralph Matega, the political analyst. Action SA say they will not back a budget that has a VAT increase within it. Does seem to narrow the field for the ANC. Does also, I think, mean that at some point there'll be a proper post-mortem about how this situation regarding the budget actually developed and the complexity. And you can imagine being the finance minister 2 hours before you're due to speak, suddenly the cabinet meeting sort of dissolves around you even in utter chaos because of this issue. Well, we'll look at that in more detail in just a moment. You with the Money Show, just gone 6:30.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
Always been a bit keen. Good to hear from you this evening on 011 883 0702 and 021 446 0567. Eskom does seem determined to go ahead with this registration process for direct customers. If you have a solar installation, would you be paying 30,000 Rand to Eskom? Would you actually do something else? And I suspect that many people would do something else. That's going to be one of the major issues. In a few moments, we'll hear from Dr. Ralph Matega, his view about the options the ANC and the Finance Minister, Enoch Godongwana, now have to actually pass this budget. And the deadline is sort of creeping up towards us quite quickly in one of those sort of strange political moments. It's actually as early as next week, depending on how you look at it. Action SA saying today they will not back a budget that includes a VAT increase. It does seem to limit the options that are now available. Well, the Remgro Group today reporting its headline earnings up by 38.9% in the 6 months to the end of December. Strong contributions from their investments in Rainbow Chicken, RCL Foods, Outsurance and Mediclinic. The group also saying while the international environment is characterized by macroeconomic and geopolitical instability, here at home, the local environment improved investor and consumer confidence. Carel Vosloo is the Chief Investment Officer at Remgro. Carel, good evening and thank you for your time. You're invested in different parts of our economy. Your food investments, Rainbow Chicken, RCL Foods, they've had a particularly strong contribution this year.
Stephen, good evening. Yes, and thanks for having me. Indeed, those two did have strong performances for the 6 months. I think it's fair to say that both Rainbow and RCL came off a somewhat low base. So I think to purely look at the increase on the prior year would be, maybe an unfair sort of comparison. But in the case of Rainbow, they've been on a multi-year journey to turn around that business. They've introduced a new breed, and very pleasing to see that that's going according to plan, and earnings coming through very nicely. And on the RCL side, also a very good story, very pleasing sort of increase, I think 29% in their underlying earnings for the 6 months. There was a big contribution by the improvement in its baking business. The groceries business did very well. And then their sugar business has been performing really well for the last 2 years, and it's managed to just about maintain that. So, yeah, good all-round performance by both those businesses.
The Outsurance Group, they reported strong earnings. I find the insurance space fascinating. It's one of those industries going through a series of transitions. There's increased competition, more weather-related insurance events as well. Do you expect Outsurance to be able to keep producing returns as strong as this one?
So, Stephen, I'm sure the right answer is yes, but you're right. Outsurance has been an absolute juggernaut. It's an amazing company. 45% up. The performance for the period. I'm not sure that we could claim that that's something that will be consistently repeated. But as they pointed out in their results, they had the benefit of lower natural peril claims. I think a year ago they had the opposite. So there is an amount of cyclicality that will come through for a short-term insurer. But I think it's fair to say that Assurance is just an exceptionally well-run company, and I think over time they would beat odds.
Your alcohol businesses didn't have quite as good a time. Cape Vin was hit. I was fascinated by this. It seems to have been a significant hit. By the end of the agreement to distribute Gordon's gin, tells you how important one product can be to some distributors.
Yeah, that's fair. Although I suppose the Gordon's gin was always coming to an end. It's a brand that belongs to a different owner, and they were distributing it and making it locally. But I think for Cape Vin, it's fair to say that the earnings is important, but this is a business of brands and stocks. So we're confident that they've got an absolute trophy portfolio of brands, and no doubt over time there's good value there. The global spirits industry is in the tough space, and it's not helped along by sort of global tariff wars and geopolitics and all of that. So clearly not a great time for that business. But we're confident that we've got very strong brands there, and in time it's a great business.
I mean, talking of all of that, you mentioned in your SENS release the global picture is getting more complicated. The local environment is seeing a bit more confidence than we've seen in the past. I mean, how do you approach the situation? Are you making any major changes in your investment approach going forward?
Stephen, not really. I think we've always been saying we take note of the macros, we take note of the local economic and sort of political environment that we operate in, but we really need to spend most of the time focusing on the things that we can influence, and for us that's been driving the performance in the underlying companies with our management teams and supporting them with the support that they need, which is different things for different companies. So that's where a lot of our time goes. And then I would say probably more than other companies, perhaps we do get involved in seeing how we can help the SA Inc. agenda, and Yanni Durant, our CEO, gets very involved in that, and other colleagues also get involved. So I think we play a part there. But then when it comes to global macros and geopolitics, I think that's a bridge too far for us. It obviously informs our risk appetite and whether we sort of are on the front foot or maybe more cautious. But we predominantly need to focus on the things we can control, and for us that's portfolio performance.
I mean, there's a lot of noise at the moment around a budget, for example. We don't have one. I mean, that kind of situation could suddenly change how everyone feels about government and sentiment around South Africa generally.
Yeah. Stephen, I think it's obviously unhelpful not to have a budget and to have this sort of stalemate there, and people not having the certainty of what the environment holds, and that's clearly not helpful. But I think we would all probably choose where we are today with a well-functioning democracy relative to where we were years before, and some of this is probably a healthy test of the system. So I'm also hopeful that the political parties will find a way to work through the differences and reach some sort of compromise that is hopefully a good basis for going forward. So uncertainty is never great, but I think it is probably evidence of some sort of democracy that we have that's good and healthy.
Carel Vosloo, thanks very much indeed. Chief Investment Officer at Remgro. You at the Money Show. Well, developments on the budget story today. Action SA saying they won't support the ANC pass a budget if there is a VAT increase. Dr. Ralph Matega is a political, social and economic analyst. You've heard from him before, of course. Ralph, good evening. I mean, if you look at the maths, the ANC, the finance minister seem to be running out of options. I mean, MK won't do it. The DA won't do it. The EFF won't do it. Now Action SA won't do it. I'm fairly certain that the sort of time is becoming a little more complex now for the ANC.
Good evening, Stephen, and to your listeners. Indeed, time is running out for the ANC, and I think this impasse on the budget, it demonstrates to the ANC that the party cannot continue with business as usual, funding the priorities that they've had over the years. So other parties are saying that, look, we are not just going to vote for the budget. We want to go deep into the budget. We want to have a say as to what constitute priorities that need to be funded. I mean, the VAT increase seems to be a funny issue here, but I think it goes far deeper, because if political parties were convinced about the priorities that the ANC wants to fund, and they were convinced about those programs, I think they will be putting effort to try to pass this, and maybe even put a word out there with their constituents and the voters that, look, it is worth going for it. But I think what is clear is that they are not in agreement about the priorities that are being put forward. I think deeper as well here, Stephen, is unwillingness by the ANC, as it is said by other political parties here, to go and clean the budget, to reprioritize spending, to actually look into the framework and say, we can do away with this, we can do away with that. But the party want to almost continue with the same framework they've had over the years, and then get votes from other parties. And parties are not wearing this. They should have looked first and foremost inside the GNU and make concessions within the GNU with GNU partners and say that, look, we are going to cut there, we are going to undertake this process of efficiency saving, we are going to deal with budget leakage as we have seen it over the years. And opposition parties, I think, they should not be seen as harboring sinister motive here. This is democracy at work, and I think budget is the most realistic, I would say, stumbling block to government priorities. And here, I think they are questioning government priorities, or the ANC priorities, so to speak.
What does the ANC do then? I mean, I think next week is one of the deadlines. Does it swallow the humiliation and remove the VAT increase?
I mean, they have to do that. If you carry on, I don't think parties are just rejecting it outright. I mean, they are saying that, but where are you going to cut in other areas? Are you going to deal with inefficiencies? Are you going to deal with corruption? When you hear about infrastructure allocation, you ask yourself, how much of that South Africans are going to see value for money? Is there a new way of assessing some of these projects that are mega projects that are underway? We've seen cost overruns and so forth. So parties are within their right to ask that. And the ANC, they are beyond humiliation now, and I think it should be about saying, let's make concessions. Let us look into our GNU partners and find concessions on this budget. Concessions might not come through an immediate dismissal of this VAT increase. Perhaps they can agree that, look, let us defer a VAT increase to the next financial year, and this year let us undertake measures that at least can agree next year as to what do we do to increase the fiscals, to get the fiscals going again.
The minister himself, Enoch Godongwana, I mean, on one level, you could point to him and say, you must take political responsibility for this. But if we look at what actually happened, he brought it to the cabinet meeting at sort of 12 o'clock, as we understand it. This was from Carol Payton's reporting, I think. At 12 o'clock on the day of the budget was the first time the DA and others heard about it. I must say the DA and COSATU the week before had said we would not accept a VAT increase. Do you think this ends with pressure on him to resign? Or does the president say, Enoch, I need you to stay? And I mean, I don't know, Ralph, who would take over from Minister Godongwana.
I mean, Stephen, under normal circumstances, you would say that the minister will be shown the door. It's like, why would you know that you know exactly that there is government of national unity here? You cannot take a risk and present the budget, consult hours before tabling the budget. And I don't know whether is this just the minister as well, Stephen, looking at it on the other hand, or is the ANC's attitude? I think that deep down there is also the question of the ANC's attitude, whereby the party still carry on as if it is governing alone. And budget is as realistic as a force of gravity. Parties are not going to pass the budget, and you're going to have to look into those priorities and revise them. There is no other way, or at least meaningfully commit to doing the process of reprioritization within the budget.
Everybody talks about it as a sort of test for the coalition. I mean, of course it is. It's astonishing looking at it now that no one really saw this coming. And I include myself in this, Ralph. Maybe you did. But I did not actually see that there was going to be such a fight over the budget. And it shows you how fundamentally things have now changed, and forever probably.
I mean, Stephen, I did not foresee this, but I'll tell you, far back, I used to imagine what will happen when other parties have to weigh in on the budget. Because for the last 8 years, it has largely been the executive budget, ANC budget, and there hasn't been any kind of, meaningful consultation with other parties about the budget. And again, look at the question of legitimacy as well. Look at the question of the mandate that the ANC has. Now, the ANC cannot pass it on its own. It does not carry the mandate as it did in those years. Therefore, it all makes sense. I mean, if you factor in the Money Bill Amendment Act, which also allows Parliament to weigh in on this, we can say that these things have been held back simply by the domination of the ANC, and now suddenly they all come to bear.
Thank you very much indeed, Dr. Ralph Matega. Really appreciate it. Political, social and economic analyst on The Money Show tonight. So much to watch with this budget process, and I think partly because you don't at this stage actually know how it's going to end. And that's one of the fundamental issues, is we don't really know what's going to happen. We can see that there's going to be a lot more stress, a lot more pressure in this process. I think we can also see that there's going to be a lot more uncertainty, and that's difficult for you, for business, for everyone to sort of deal with. There is also the problem, and I keep coming back to one of the conversations we had in the hours after the budget, that in fact to have a 0.5%, a sort of 0.5 percentage points VAT increase may not in fact be possible for some companies, that their systems won't allow it. Now, it's one thing to say, you must do it, the voice of government, thou doth will, you will do it. But what if you actually can't? And now we're in a situation where the clock is ticking down, the deadline's getting closer, and all of this will happen at the last minute. In a way, typical of our politics.
The Money Show with Stephen Grootes, brought to you by Absa CIB, proud sponsor of the Bonds, Loans and ESG Africa 2025 conference.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes, brought to you by Absa CIB, proud sponsor of the Bonds, Loans and ESG Africa 2025 conference from the 25th to the 26th of March at the Cape Town International Convention Centre. Good evening. Welcome to the second hour of The Money Show. I'm Stephen Grootes. We'll talk tariffs, pricing, electricity, Eskom and solar power in just a moment. Some insights from Chris Yelland I'm looking forward to. Dr. Rutendo Huntwingi already sitting behind me, ready to explain to you and advise you on what's happening on our continent in the Africa Update. And then also what happens when you chop and change your investments, personal finance this evening with Warren Ingram. You might well have a thought or two or a comment about Eskom and the way they appear to be treating solar customers or customers who have solar power as well. Be good to hear from you tonight on 011 883 0702 and 021 446 0567.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, I don't know if you noticed from the start of the year, there was some public commentary about how electricity pricing is going to change. Part of that relates to how Eskom wants to manage its direct customers, which may well be you, who actually have a solar power installation. Some of these seem to suggest Eskom was in fact going to charge quite a large amount to register those installations. There are a huge number of other changes happening all at the same time, and I think we're now beginning to get some proper facts from Eskom about what is going to happen. Chris Yelland is the Managing Director at EE Business Intelligence. Chris, good evening, and thank you for your time once again on The Money Show. Firstly, the stories we've seen over the last few months, Eskom is going to charge a large amount. I now see around 30,000 Rand for customers who use their solar installations to register them. Is that true? I mean, would someone really have to pay 30,000 Rand and actually receive nothing of value in return?
Well, it is true that there are going to be significant costs for customers as they register their systems with Eskom. The reality is that, Eskom require you to have permission from them as the network provider before you connect a solar PV and battery energy storage system to their network. Now, in the past, they have really not been in a position to enforce this, and I received a note from Eskom probably about 18 months ago that there were some 27,000 low voltage installations, solar PV and battery energy storage installations connected to the network without the necessary permission from Eskom. And this is a compliance issue. So you have to meet certain compliance conditions before they will, connect you. And there are some very significant costs involved. So, for example, they've introduced a new tariff called the Home Flex tariff. And whether you export power into the grid or not, you are required to have a meter, electricity meter, that can communicate remotely, that can handle imported and exported energy into the grid, that can implement time of use tariffs. And these meters are quite expensive. Not only are they expensive, but you may need a kiosk to put them in. You need installation costs. You need to get a quotation from Eskom before you even start. And funnily enough, just to get a quotation, you have to pay Eskom money in order to get a quotation. Then, of course, the quotation tells you how much money you're going to pay for the meter and the installation and the kiosk, etc. Then you've got to get sign-off by a professional engineer, which could cost anything, 20,000 Rand. And finally, you have to pay Eskom a connection fee to actually come out and connect you. So, yes, there are significant costs involved. And Eskom has kind of said that this has to be done by the end of March next year. So they're giving you a kind of a period in which to comply. But to comply, there are very significant costs involved.
Is the cost as high if you're supplied by a municipality? So City Power, for example. I mean, you can live in one part of Sandton and be supplied by Eskom. You can be on the border of Sandton and have City Power electricity. Is City Power going to charge as much for exactly the same thing?
Well, with City Power, you don't have to have a meter that can handle imported and exported energy if you're not exporting energy into the grid. Some municipalities, most municipalities, don't even have tariffs for exporting power into the grid. And many municipalities really are not in a position to even enforce the compliance in any shape or form. So in many municipalities, people just do their own thing. Technically, they don't have permission to connect to the network. But the network provider is not in a position to go out and check this and inspect it and enforce compliance. So there is a very large number of technically non-compliant installations. It's like e-tolls. If you have 27,000 non-compliant, technically illegal installations, the network provider is just not in a position to enforce it. Then the whole thing falls into disuse and gets abandoned, as has happened with e-tolls.
It would seem to me that if someone has invested, probably taken money out of their bond to do it, if they're in a stage of life in which they have one, taken money out of their bond to invest in a solar installation. Let's say they paid 150,000 Rand. And you say to them, you need to now pay another 30,000 Rand. Their choice actually, because of the way that the technology around solar has changed, is to either pay 30,000 Rand to Eskom and get, for them, nothing in return, or to invest that 30,000 Rand in upgrading their system. Maybe they get more battery storage, and maybe you get a generator for, very gloomy periods like we've seen in February and March. And what that means is that people will say to Eskom, go ahead, I want nothing further to do with you. And the reason that this worries me so deeply is that in this electricity transition, I think it's vitally important that South Africa keep richer people in the grid to subsidize the poorer people who have to stay in the grid. And I worry that Eskom may actually be making a big mistake here.
Stephen, I know a senior executive, former executive at Eskom with a PhD in electrical engineering, who retired a couple of years ago and went farming apples in Standerton area. He used to be a senior consultant in Eskom distribution. And he told me that on his farm, he has gone completely off-grid because it is simply too expensive to buy electricity from Eskom, and he operates his farm off a battery and a solar PV system. And that is what many people in rural and semi-rural environments are thinking about, that the combination of a solar PV system plus a battery plus a petrol or diesel generator for those fairly rare days when your battery is flat and there's no sun, then you operate a petrol generator for that short period. Yes, a petrol generator, the cost of fuel is high, but if you only use it for a couple of days a year, the rand cost of the fuel is not that significant. And this combination of a battery, a solar PV, and a generator is the basis of what is known as a microgrid. And microgrid installations are becoming more and more economically viable. Even Eskom is promoting microgrids for rural installations where it is too expensive to provide them with a grid connection. So, yes, there is a growing, these things are becoming more economically viable as the price of Eskom grid electricity gets higher and higher, and people start defecting from the grid with very significant negative consequences that you pointed out.
Okay, if we just forget about solar for a moment, it's dark outside, so that should be easy. The situation around tariffs and the way that Eskom is going to charge its direct customers is changing quite dramatically, and I realize that tariffs is very complex. There's a large number of them, and it's almost impossible to sort of summarize it in a simplistic fashion. But I presume that many people are going to be paying significantly more for electricity, and in fact, the way the tariff system works has to change.
Look, I've done a study recently for OUTA, the Organization of Undoing Tax Abuse, because I'm the energy advisor to OUTA. This study has focused specifically on Eskom's new residential tariffs. Now, there's only three Eskom residential tariffs. There's the Home Light tariff, which is targeted at low-income customers, typically with prepayment meters. There is the Home Power tariff, which is aimed at sort of middle-income and upper-income customers. And then there's the Home Flex tariff, which is really targeted at upper-income customers who are in a position to shift load, to shift their domestic appliances to times of the day when demand for electricity is low. This is a so-called time of use tariff. So there are three tariffs, and not only have the prices, the tariff rates gone up, but there's been a fundamental restructuring of the tariff, which is going to have on the 1st of April very widespread implications for residential customers supplied by Eskom. And the interesting thing about it is that smaller and therefore poorer customers are going to pay much higher increases for electricity than larger, wealthier, more well-to-do customers. In fact, larger customers are going to even have reduced electricity bills going forward, whereas smaller and poorer customers are going to have significantly higher increases, higher than the average. So like the average increase we know is 12.74%. Smaller users on all these tariffs are going to be paying much more than 12.74% increase, and larger customers are going to be paying much less than 12.74%. And in fact, the larger this customer is, some of them will even be getting a price reduction this year. And this is as a result of changes in the cross-subsidies between, there are cross-subsidies at the moment which subsidize poorer, in other words, wealthier customers subsidize poorer customers. Urban customers subsidize rural customers, and large customers subsidize smaller customers. And as they readjust these subsidies, so you're getting changes, and ultimately the increased prices are significantly impacting the poor more than the more well-off customers.
Sure. And it doesn't seem to me that any of this is going to end well. Chris Yelland, I really appreciate the time. Thank you. Managing Director at EE Business Intelligence.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Time now, of course, to get an update on what's happening around our continent. Rotendo first, 1-0 is what I see, right?
1-0 to South Africa.
1-0 to South Africa against Benin.
Not too shabby.
And of course, Lesotho, and the outcome is now going to be mired in controversy over Tebogo Mokoena, etc. Dr. Rotendo Ndungi, we'll try and keep our minds off the football for a moment. Founding director of the Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. There's been a lot of talk recently about African integration, about moving us all together, and everyone's kind of happy with it until it comes to the movement of people. But it does look like financial integration is beginning to move more quickly, and there's a currency exchange marketplace.
Yeah, so that's very true, Stephen, and a good evening to you and your listeners. So I think you've actually hit the nail on the head. The movement of people and goods is actually more difficult, but when it comes to technology and finance, much more easier. And a case in example of this is the Africa Marketplace, which is a platform that is part of the Pan-African Payment Settlement System, short name PAPSIS. And it's a platform that was installed by Afrexim Bank and is managed by Afrexim Bank. And basically what this platform does, which is part of PAPSIS, is it allows it facilitates the direct currency payment between countries. So which is a big thing, because one of the big challenges of doing intercontinental trade is the length and the time and the inefficiency of transactions. So this is a big thing. It also enhances liquidity and stabilize currencies within the African market place. And a good example, for example, is that if you're going from Nigeria to Ethiopia, you can buy your ticket from Ethiopia in Naira. And then you can, and at the same time, the Ethiopians using the birr can also buy stuff in Nigeria. So that's the theory behind it. The marketplace, I think, should be opened up sometime this year. There's a lot of excitement around it, and it opens up a lot of opportunities just in terms of the capital market for Africa, because once here you have easy movement of liquidity between countries. It allows investment decisions. It allows assessment decisions around investment into a better place. So it's a positive step, and easier, as I said, than the free movement of goods and people, which is the overall AfCFTA ambition.
And then the trade agreement talks between the UAE and Tunisia. These will be very interesting to watch.
Yeah, so the UAE or the GCC countries, because the UAE is part of the GCC group of countries, is making significant inroads in terms of further investment with Tunisia. They've made a pact. It's their 27th pact with a number of countries. It's called the Comprehensive Economic Partnership Agreement, CEPA. And the UAE is basically trading at the moment, if you take oil out of it, because obviously oil is always a big differentiator, but with Tunisia, which is an African country, there's about $350 million worth of trade that is happening, and this relates to non-fillet meat. I think it also relates to fluoride, which is probably manufactured in one of the two countries. But the other significant investments or trade deals that the UAE has also made in Africa is with Kenya and also the Central African Republic, and one of those deals over a number of years amounts to about $1 billion. So, and the reason I highlight this is I think it's estimated since probably 2014, 2015, there have been about 80 projects that the UAE or the GCC countries have done into the African space, and it amounts to over $50 billion. And I think the big highlight here, Stephen, is that there's a lot of opportunity, and it's creating downstream jobs and opportunities as well. So it's a positive thing from a Middle East Africa relationship.
We've been talking about Starlink quite a lot, mainly to distract us from its owner. And there's a startup called Tara. It's owned by Google. It doesn't use radio beams. It uses beams of light to provide a similar service.
Yeah, so, two things to highlight. Obviously, the technology itself is very innovative. So it's balloons in the air, not the balloons that you and I buy from crazy stores, Stephen, for kids at once upon a time. But these are quite advanced balloons that trap or utilize the light beams from the sun and convert that into technology, in terms of data. Just to give you some estimations, it shows that it could transfer that technology 700 terabytes of data at a speed of 20 gigabytes across 5 kilometers up to 20 kilometers. And one of the key things that Google has highlighted is that the success of this technology is because it's been piloted in Africa. So hopefully they'll give us huge discounts around that. But it's definitely a competitor to Starlink. Whether it will have the bandwidth, to use that term, no pun intended, in terms of competing with Starlink, that's another thing to see. But one of the big investors that's involved in the testing and the rollout of this solution, Stephen, is Strive Masiwa, who owns the Liquid Technologies company, and they've been involved in the piloting, and they're quite involved in the rollout of this. So it's great from an African investor being involved in the story. And another thing about Strive Masiwa, recently they've also signed off with NVIDIA to start off an AI factory in Africa. So it's another big story in terms of opportunity and getting multinationals to invest in Africa, albeit with our challenges. But it'll be interesting to see how much traction Tower will do in terms of giving Starlink a run for its money, because Starlink, I think I was reading another article, Stephen, and Nigeria has bought into it quite significantly. And with Nigeria, you've got the population, you've got the appetite, you've got the entrepreneurial spirit, and all of those add up. So, but it's good to have competition with regards to this kind of technology, and it gives the continent options.
I've often thought that Elon Musk actually wants a monopoly. That's what he's pushing for, and that's what you've got to be quite nervous of.
Very true.
And then in Nigeria, there's going to be a big lithium processing hub in Kebbi.
Yeah. So lithium, one of the big incentives for lithium is that the whole EV route of electrical vehicles is driven by lithium with regards to the battery and the sourcing thereof. Nigeria has not been left behind. One of the big things about Nigeria, obviously the most populous country on the continent, and one of the top two economies, is that it has been trying to diversify from the oil and gas regime. So they've invested in lithium. They've teamed up with the two companies that are involved. Is a Nigerian company called El Tahadum, and the other one is TSG Mining. And funny enough, the head office for TSG Mining in Africa is actually here in Limpopo, which is quite interesting because usually you hear a bit of argy-bargy between South Africa and Nigeria, but here are two companies with a regional head office here that are working together to produce lithium. The mining in itself, the investment that is being injected there, Stephen, is $500 million. 250 of that million US dollars is coming from TSG, and the downstream effect is 1,000 direct jobs will be created and 3,000 indirect jobs will be created. So it's a great story to have as well with regards to industrialization on the continent.
Dr. Rutendo Hundwingi, good to see you. Thanks very much indeed. Founding Director at Tribe Africa Advisory. Bringing the time now to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
23 minutes now to 8 the time. One of the most important things to do when you're trying to invest is actually an issue of consistency. And that's something that we're going to be focusing on today, and just looking at how this managed. Warren Ingram, of course, is a certified financial planner at Galileo Capital. And his question, Warren, that you're asking tonight is, are you chopping and changing your investments to zero? And I have to say, this is really about that urge when you've made a decision to change it because it's not working out for you.
And it's such a human instinct, Stephen, where we see a problem and we want to take action and we want to correct the problem and drive our investments in a new direction. And it's a very human thing. We're hardwired that way. Usually when we were kind of pre-civilization times, hanging around and thinking about things and taking our time probably would mean that we would be killed by a predator. So it was, entirely in our interests and in our wiring to make sure that we did something about the problem, either ran or climbed a tree or fought. And those are all great instincts for survival, but unfortunately, terrible instincts when we're in the investment world, and it happens so often when we talk to people about money that and things are not going well. For example, there's a big stock market crash or there's political upheaval. That just sounds like every day in 2025 so far. But when that happens, people want to know what's the plan, what's the action, what should I do to fix the problem or stop my investments losing more money. And very often the best answer you can give someone in a situation like that is sit on your hands and don't do anything. And it's almost the hardest thing to do.
The other point is that I suppose you end up changing your investment at the worst possible time because it's a moment of great stress in the market.
Yeah, so there is this phrase, the madness of crowds, and if you want to see the lack of intelligence of a crowd, the best way to do that is look at a large number of investors taking action almost at the same time, and so the biggest crowds to me that you can really measure are global stock markets, and when we analyze the behavior of investors. And the thing to understand here is I'm not having a dig at just professional investors or just private investors. I'm talking about all of us, all investors. When you see what we do and the decisions that we make as a collective, they're not that clever. With the benefit of hindsight, when we look back and we analyze what's happened, we tend to collectively make the biggest mistakes at the same time, and we do it repeatedly. So just to give you an idea, in the beginning of 2024, investors sold about 35 billion rand out of unit trusts in South Africa, and the sector that really suffered the worst outflows was those that invest, especially unit trusts in this case, that invest on the stock exchange, on the Johannesburg Stock Exchange. And the sector that benefited the most, so the unit trust sector that got most of that money, was the money market unit trusts. Now, over the whole of 2024, the JSE delivered a return of 13%, which is pretty good return. That's that if you do that for 6 years, you've doubled your money. And at the same time, money market unit trusts delivered a fantastic return of about 7 or 8%, and that's not taking into account tax. And just to be clear, I'm being sarcastic there. 7 or 8% before tax is really not a good return. So in essence, you switch out, and we do it collectively. We switch out of the thing that did badly the year before, and that's exactly what happened. The JSE didn't do well in the year before, and so we switch out collectively, all of us, and then we put all our money in cash because we want certainty, and so we end up with a return after tax of probably 4 or 5%, while the JSE delivered a return of 13%. And that's the point there, Stephen. Do nothing and you get the 13%. Do something and you get 4 or 5%. It's a really bad outcome.
Okay, so then what do we do? I mean, how do we approach this? And, you can be sitting on the edge of your chair, not even able to sit down at all, because you're just so nervous watching your money disappear, or it can certainly feel like that.
And maybe that's the very first thing. You make such a great comment there. We're investing is not an entertainment. It's not an action sport. It's not a game. We shouldn't be watching our investments very often. We shouldn't be looking at them daily or weekly or monthly. If you're doing that and you're getting a form of entertainment, and sometimes like watching your investments go down can be like a gruesome form of entertainment, like watching a car crash. That you need to understand things are not going well for you, because investing should just not be a form of entertainment. Then you're doing it wrong. It should be boring. So if you own an investment that hasn't done well, let's use the example of a unit trust that invests in the Johannesburg Stock Exchange. If it hasn't gone well, then what you need to do is go and Google and see what did the Johannesburg Stock Exchange actually deliver over the last 12 months, and then compare that to your unit trust. If your unit trust has gone down by 5% and the Johannesburg Stock Exchange has gone down by 10%, guess what? Your fund is actually not doing too badly. It's still down, but now you need to understand that in its context, the things that it can buy, it's actually doing okay. And understand then that if things have gone down last year, there is a decent chance that they're going to go up this year. And so then you've got to sit tight and do nothing. However, if the stock exchange has gone down 10% and your investment has gone down 30%, then it's probably time to do some more homework, to do some more digging, because the likelihood is that you could be in a fund that's being really badly managed, and you should be switching. Or it might be that you've bought a particular manager who's bought things that are really dirt cheap, in the hope that they're going to deliver fantastic returns. But before you do anything, before you just make a switch, the very short answer is you have to do your homework. You have to understand the context, and very often exercise another year of patience. And I want to use a great example here. Last year, We looked at the tech companies in America that absolutely boomed because of the AI boom. So we would see very large companies doubling their value over a year, which is almost unheard of. And it's no surprise that investors piled into tech companies towards the end of last year and certainly at the start of this year. In contrast, there was this little sector called the arms manufacturers in Europe. And, middle of last year, early last year, they weren't doing very well, very much like the whole of the European Stock Exchange. But, come President Trump and his vice president who unleashes fury at the Europeans for not spending enough on arms manufacture at the start of this year and kind of scares them by saying we might not support you. And all of a sudden, tech shares are down a lot and arms manufacturers in Europe are booming. You don't know that that's going to happen if you're an investor. So you need to make sure that you own, and that's maybe my second point, you own a good spread of investments and then you stay patient.
I was about to say, I can hear you saying it already, Warren. It's about diversification. And when you diversify, I suppose you have to accept a little bit of pain. You have to know that not everything is going to do so well.
Exactly. I almost want to say to you, if you own a properly diversified portfolio of investments, there has to be one portion of your portfolio which is losing money. If not, let's say everything's delivering the same growth. Let's say your top performing investment is delivering 25% and everything else is delivering 20%. I'm going to suggest that you've got absolutely no diversification whatsoever. You might own 5 different unit trusts from 5 different unit trust managers, and therefore you feel that you're nicely diversified. But I bet if everything's performing in the same direction and in the same amount at the same time, all you've got is different brands on the same basket of shares and that they all own together. The way that you know you've got diversification is if a few of your investments are doing 10 or 15 or 25% and 1 or 2 of them are doing -1 or -5, because that means that they own things that are performing at a different time and in a different way. And when the cycle turns, and none of us know when that's going to happen, the things that are doing well last year might not do so well this year, and the things that were losing you money last year might become your star performers. So diversification means owning things that hopefully most of them are doing well and some that aren't doing well, and that's a badge of honor. You need to know this is a good thing. That clown on the radio who tells you about diversification is actually telling you some of your stuff is not actually going to do well every single year of your investment career.
Is there a sort of percentage of doing badly that you should tolerate, and past that zone actually you need to change things? If 10% of your investments are losing you money, do you need to sort of, is there some sort of rate at which you kind of think you can look at your spread of diversified investments and think, actually, I'm losing too much here? Or does it also depend, I suppose, on how well the rest of it does?
I think that's a good comment. If you've got a portion that's doing incredibly well and a larger portion that's not losing very much, but it's not doing well, if on balance you're still growing your money, that's a very good sign. I think at the start of the segment you said consistency. So, I mean, in an ideal world, what you're aiming for is, an investment portfolio that grows, year after year, and it may not reach the peaks of the stock market. So if the stock market's generating 25% and your portfolio is only up, 10 or 12%, but the next year the stock market's down and your portfolio is up 8%, well, that's good diversification. So I think I would say you're aiming for consistency, and secondly, you need to understand each of those pieces of your portfolio and look at them in their context. So let's just look at global investments did really well last year, but fast forward a year and the rand is a little bit stronger than it was a year ago. So when you look at your global investments, they might not look that great, whereas the JSE is probably still up around 25% over the last 12 months. So just understanding each piece of the puzzle and then looking at the whole, you would hope that, more than half, maybe 60 or 70% of your investments are growing. But I always remember a very famous investor called Sir John Templeton, and he says over his entire career, he thinks he did incredibly well because 51% of his investments made money and 49% didn't.
Sure. Yeah, no, that does make sense. Warren, we have a question for you from Michael. He says, I see some investment companies have now launched exchange-traded funds that seem to be the same as their unit trusts. What's the difference? Should I buy the ETF or the unit trust? Michael, we'll have an answer for you in just a moment.
The Money Show with Stephen Grootes, brought to you by Absa CIB, proud sponsor of the Bonds, Loans and ESG Africa 2025 conference.
The Money Show.
Personal Finance with Warren Ingram.
And Warren, there was a question for you from Michael saying that some investment companies have launched exchange-traded funds. They seem to be the same as unit trusts. What's the difference? It's a fascinating question, actually, because I think this is where the complexity or the technicalities of it can almost overwhelm us ordinary people.
and every single day there are more and more versions of exchange traded funds that are getting launched. So now when just a very quick history lesson, when exchange traded funds were first launched, all they were index tracking investments. In other words, something that would track the top 40 shares on the JSE or the American stock market or the world stock markets. It was very simple. You knew what you were buying because it was just the entire market, or as close to the entire market as you could get. And they were very low cost, very efficient, and very easy to understand. Unfortunately, the financial services industry doesn't like simplicity. So what it did is it created complexity. Every new entrant into the exchange traded fund market had to be a little bit different and had to differentiate themselves and find ways to attract assets. So now we're in a world where there are a huge range of exchange traded funds, including these relatively new things called actively managed exchange traded funds. So now you'll get an investment company that's been running unit trusts for the last few decades, and they will go and launch an actively managed exchange traded fund that looks identical to the unit trust that they've been managing for many decades. And I think it is confusing, and I understand Michael's question. Maybe for me, I think simplicity is always valuable. So in a situation like this, I think you cut it down to the way you're going to invest. So if you've got a monthly debit order and you want to keep your transaction charges as low as possible and keep things easy and simple, then just go for the unit trust that's appropriate for you. If you've got a portfolio of shares and you tend to operate a stockbroking account and you're going to be investing ad hoc amounts, every now and then you're going to buy or sell something, then perhaps the exchange traded fund is better because it's not going to be that efficient for monthly debit orders. But you need to be careful. Exchange traded funds, they're going to cost you money when you buy them, and they're going to cost you money when you sell them. So you don't want to be paying away the bulk of your money for small trades of 200-300 rand, where you're actually paying a huge brokerage cost. So I would say, Michael, very large lump sums. If you're not in the unit trust world and you want to stay in the stockbroking world, do large lump sums on exchange traded funds. If you're going to do debit orders, then consider unit trusts. I hope that helps to kind of give you some direction.
No, I think that must do. All right, thank you. In terms of sort of staying online, in other words, staying on in your line and not dropping and changing, there's a lot of noise. I mean, when something happens in the markets, and I mean, I contribute to the noise, so I know of which I speak. But how do you avoid the noise?
I think you've got to listen with a pinch of salt. So understand that the people that are in the media, whether it's on radio, TV, nowadays, a lot on social media, the people that develop a very big following, and I always think of kind of Jim Cramer in the States, they develop a very big following because they're great entertainers. They can deliver a fantastic message with a huge amount of confidence. They sound intriguing. They throw a lot of facts at you, and that's, it's entertainment. It's not investment recommendation. The people that are commentating know nothing about you, so they're giving a view, and it might be given with the best will in the world and the best intent, but that doesn't mean that it's gospel advice that you should be saying, I'm going to follow them because they sound like they know what they're talking about. I think if you want to make sound investment decisions, develop an investment strategy that focuses on 5, 10, 15-year time horizons. Don't worry too much about what happens over a day or a week or a month or a year, because an enormous amount can happen in a very short space of time, and it could drive you crazy trying to anticipate where markets are going, trying to understand what all the experts are saying about the next week or the next month. And what you need to know is economists can't even predict the direction of interest rates from 1 month to the next. They can't tell you with any accuracy whether interest rates are going to go up or down over a 1 year period. So if they're on the radio or they're on TV and they're blaring their views, their entertainment, that's not the way you make investment decisions. You need to say to yourself, this is my age, these are my investment targets, this is what I would like from my money, and then make decisions for the next 5 years. And if you're always focused on that long-term view, then the short-term stuff that's happening is maybe interesting. I mean, my view is you can give it kind of a little bit of attention, but not too much, and rather sit with long-term goals and ignore the noise. And I think if you want to understand the great investment experts, they usually start with things like, I'm not really sure what's going to happen. I don't really understand what's going on right now. They're not hugely confident. They don't sit there with very confident predictions. They sit there saying, we think this is how the world's going to unfold, but we're not sure. And for me, the one lesson here is overconfidence in the investment industry is a real wealth killer. So it's okay to be uncertain, but don't chop and change. Stick to the long term. My famous D word, diversification, is your big friend in a situation like this. And if you can be diversified and have a long-term focus, I think you're largely insulated from the noise that's freaking everybody else out.
There was a piece, I think, in MoneyWeb, I think it was by Isaac Oorzendaal, who, if I remember, is at Old Mutual, who said, nobody knows what's going on. And that, to me, just explained precisely the situation we're in at the moment.
Exactly. It takes a lot for a so-called expert, when they get asked a question on the spot, to say, I actually have no idea. That what they're going to do is give a view because they were asked for a view. But if they were really honest, they would say, I don't know. However, this could happen, we could be going left, or this could happen and we could be going right. And these are the range of outcomes that we should expect. But for someone like me is just an investor and I just want to grow my money, that view based on what's going to happen in the next week or month or even year shouldn't really change the direction of my investment portfolio. It should be built for 5 or 10 years, and it should be built to deal with all of this kind of noise that's going to happen year after year.
Well, Warren, as always, thanks very much indeed. Warren Ingram, co-founder of Galileo Capital and a certified financial planner. If there's someone in your family who you think needs to listen to this, do send them the podcast, which will be available in a few minutes.
The Money Show with Stephen Grootes, brought to you by Absa CIB, proud sponsor of the Bonds, Loans and ESG Africa 2025 conference.
That's it for The Money Show. Plenty to come, of course, so do stay listening to Aubrey Masango. He is next. We'll be back with you tomorrow. Plenty going on in the United States. Some of the political stuff is just incredible. So thanks very much indeed for being with us. It's 8 o'clock.